The very first day a new trader ventures into this arena, they almost invariably commit a series of predictable, fundamental errors that rapidly consume their capital and shatter their dreams, transforming initial optimism into bitter regret within a mere 24 hours. This sudden, often perplexing, demolition of capital is not an accident of fate, nor is it the result of particularly cunning market forces targeting the novice. It is the direct consequence of universal psychological pitfalls and a profound misunderstanding of the market's true, unyielding nature. The untrained mind, filled with hope and impatience, becomes its own worst enemy, blindly navigating a landscape governed by immutable laws it has yet to comprehend, let alone respect. The market, in its chilling indifference, cares nothing for your ambition, your intellect, or your initial capital. It operates by precise, unforgiving laws, ruthlessly punishing ignorance and consistently rewarding disciplined, objective execution. This video will not offer you false hopes or empty promises of shortcuts. Instead, I will lay bare 10 common, yet catastrophic, pitfalls that every new trader, often unknowingly, plunges into, leading to rapid and inevitable financial ruin. These are not mere suggestions of minor missteps. These are the grim, unvarnished truths, observed through countless unfortunate examples, that relentlessly separate those who manage to survive and learn from those who are swiftly and mercilessly expelled from the game, their dreams of fortune reduced to ashes. My own early years were filled with such costly tuition, paid in the currency of bitter experience and devastating losses. My purpose here is to illuminate these treacherous pitfalls with unflinching honesty. By recognizing these predictable psychological and strategic traps, the very errors that consume fortunes within a single day, you gain the critical foresight to avoid them. Only by understanding the anatomy of these common beginner failures can you hope to navigate this perilous landscape, preserve your precious capital, and lay the groundwork for genuine, enduring market mastery. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. The very first and arguably most fundamental error that nearly every new trader commits, often within their inaugural hours of market engagement, is to embark upon the tumultuous seas of speculation without a clearly defined plan. They initiate positions without a precise strategy for entry, without a specific, quantifiable objective for the trade, and most critically, without predetermined parameters for managing the inherent risk. This approach is akin to a captain setting sail on a vast, unpredictable ocean with no chart, no destination, and no emergency protocol should a storm arise. This profound absence of a coherent blueprint inevitably leads to a state of utter aimlessness, a paralysis of purposeful action. Every decision becomes reactive, dictated by the immediate, often emotional, fluctuations of prices, by the sudden surge of fleeting hopes, or by the persistent whispers of external noise and unverified rumors. Trades are initiated not based on logic or a predefined system, but on impulse, on a desperate hope for quick gains, or on the compulsive, untrained desire to do something. This critical lack of a guiding blueprint ensures that precious capital is scattered randomly, exposed to every storm, and ultimately, systematically wasted in a series of ill-conceived actions that have no rational basis for consistent success. This leads directly to the second common pitfall, chasing the market. Overwhelmed by the fear of missing out, FOMO, as prices surge, inexperienced traders succumb to a powerful, irrational urge to jump into already moving stocks, convinced that the opportunity will vanish forever if they hesitate. They allow their emotions to dictate their actions, abandoning all semblance of disciplined observation and patience, plunging headlong into a current they do not understand, driven by a desperate need to participate. The fatal flaw of chasing is that it invariably leads to entering the market at precisely the most unfavorable prices, often at the tail end of a significant move, or worse, just before an abrupt reversal. These impulsive, late entries render the new trader an immediate victim of the market's cunning reversals, transforming perceived opportunities into immediate, painful losses. They are perpetually outmaneuvered, buying at the peaks of enthusiasm and selling into the depths of panic, a direct consequence of their reactive, undisciplined approach to market engagement. Ultimately, these two foundational errors, the utter lack of a coherent plan and the impulsive pursuit of a runaway market, guarantee a swift and brutal introduction to the market's unforgiving nature. They ensure that even the most promising initial capital is rapidly eroded, leaving the novice disillusioned and financially crippled, all within the span of a single, chaotic day. The market, in its merciless efficiency, quickly weeds out those who refuse to prepare or to act with objective, disciplined foresight. The third pervasive error, intimately intertwined with the desire to chase, is overtrading, the insidious addiction to constant activity. This compulsion is driven not by genuine market opportunity or a reasoned strategy, but by a relentless need for motion, for the thrill of being perpetually in the game, regardless of whether favorable conditions truly exist. It is a profound misunderstanding of the market's true nature, tragically mistaking incessant motion for genuine, profitable progress. This pervasive addiction to activity is often fueled by a deep-seated boredom during periods of market indecision, or by the gnawing fear of missing out on what appears to be a rapid, profitable move. The speculator, unable to tolerate strategic inaction, succumbs to the restless urge to place trades, even when no discernible signals are present, or when their own system dictates patience. This psychological discomfort with idleness compels them into continuous, often ill-conceived, transactions, systematically eroding their capital. Overtrading systematically consumes precious capital not only through the immediate losses of ill-conceived ventures, but also through the insidious drain of excessive commissions and spreads. Each unnecessary transaction, each ill-timed foray into unconfirmed territory, relentlessly chips away at the trading account, even if the individual losses are small. This constant bleed, often underestimated, can rapidly deplete funds, leaving insufficient capital for truly significant opportunities when they finally, inevitably, emerge. This leads directly to the fourth fatal error: the refusal to cut losses, sustained by blind hope. The new trader, having committed to a position that moves against them, clings desperately to the delusion that the situation must eventually turn around, that the market owes them a recovery. This insidious hope, fueled by ego and an unwillingness to admit being wrong, transforms what should have been a minor, manageable setback into a sprawling, account-annihilating financial catastrophe. This psychological paralysis, driven by the desperate desire for vindication, prevents the speculator from taking the necessary, immediate action to preserve capital. They watch, tormented, as losses mount, unable to sever the ties with a losing position, because hope whispers that the market will somehow bend to their will. This profound refusal to accept reality escalates small, manageable errors into significant, even catastrophic drains on capital, often leading to total ruin within a single day or a few short days. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. The fifth common pitfall is born from a dangerous, yet seductive form of self-deception: averaging down. This is the attempt to fix a losing trade by purchasing more shares at a lower price, under the misguided belief that one is getting a bargain or lowering their average cost. This act, which appears logical on the surface, is in fact a desperate and profoundly destructive strategy, pouring good money after bad, and compounding an initial error that the market has already unequivocally condemned. The market, in its unyielding wisdom, does not negotiate with the speculator's desire for a bargain. A stock that is actively declining is doing so for a reason, indicating underlying weakness, not hidden value. To add to such a position is to double down on a mistake, multiplying one's exposure to a trend that is clearly moving against them. This pursuit of a perceived bargain invariably transforms small, manageable losses into catastrophic, irrecoverable defeats, often wiping out an account within days. The sixth common error is the seductive allure of trusting tips and outside information. The promise of easy money, of a shortcut to riches revealed by someone with inside knowledge, is an almost irresistible siren call for the inexperienced. Yet, relying on such hearsay fundamentally undermines the very foundation of independent judgment and objective observation, which are the absolute prerequisites for genuine success in speculation. The information derived from tips is almost invariably too late, biased, or entirely fabricated. By the time a hot tip reaches the average speculator, the truly informed money has already acted, and the opportunity, if it ever existed, has been fully exploited. To act on such belated or unverified information is to be perpetually relegated to chasing the market, forever a step behind, systematically exposing capital to unnecessary risk based on unreliable whispers. This leads directly to the seventh pitfall: trading without emotional control, succumbing to the tyranny of fear and greed. These powerful human impulses invariably override logic, corrupt judgment, and compel actions that directly violate even the most carefully constructed principles. Fear paralyzes, leading to missed opportunities or premature exits. Greed compels overtrading, excessive risk, and an inability to take profits, pushing the speculator to demand too much from the market. The market is a relentless crucible for emotions. It masterfully sets psychological traps, amplifying inherent human predispositions to lure traders into predictable errors. Without the iron discipline to maintain objectivity, to silence the turbulent inner landscape of hope, fear, and greed, Even the most brilliant analytical mind becomes utterly impotent, turning rational plans into impulsive, ruinous reactions that guarantee rapid capital erosion. The eighth and final mistake, a pervasive blind spot for nearly every new trader, is the catastrophic neglect of capital preservation. The beginner, captivated by the allure of making quick profits, invariably prioritizes potential gains over the absolute imperative of protecting their initial capital. They risk disproportionate sums on single trades, fail to set or honor protective stop losses, and treat their funds as expendable ammunition in a game of chance, rather than as the lifeline to their entire trading future. This fundamental misunderstanding of risk management ensures that even if a new trader avoids some of the other pitfalls, their capital remains perpetually vulnerable to a single, devastating blow. When profits are prioritized over protection, the market, in its ruthless efficiency, will inevitably confiscate their funds, reducing their account to zero and swiftly expelling them from the game before any genuine learning or long-term success can ever be achieved. These 8 common pitfalls: trading without a plan, chasing the market, overtrading, refusing to cut losses, averaging down, trusting tips, lacking emotional control, and neglecting capital preservation, manifest rapidly within a new trader's first day, or certainly within their first few days. They combine to form a predictable blueprint for financial ruin, systematically dismantling capital and shattering confidence with ruthless efficiency. However, the ultimate truth revealed by these costly lessons is also the path to survival. The counterintuitive solution is not to find a secret indicator or a guaranteed system, but to consciously and meticulously avoid these very mistakes. By recognizing these pitfalls, by cultivating disciplined habits, and by prioritizing the preservation of capital above all else, the beginner can navigate the treacherous currents where others are relentlessly wrecked. My own career was a testament to this very process. My millions were lost, not through a lack of understanding of market mechanics, but through the painful, repeated transgression of these very principles. It was only by confronting these psychological flaws, by embracing relentless self-discipline, by mastering objective observation, and by learning to let the market come to me, rather than chasing it, that I transformed ruin into wisdom and eventual fortune. This video serves as your most vital guide, your blueprint for survival. It is the unvarnished truth, forged in the crucible of devastating losses, yet freely offered to those who possess the wisdom to listen and the courage to act. The path to becoming a professional speculator begins and ends not with grand predictions, but with the humble mastery of oneself, disciplined observation of the market, and the unwavering commitment to avoid these ruinous traps.